Yeah, I think it's pretty bad out there. There's obviously been a pretty dramatic change from risk on to risk off in the space of a little over a year. If we think about a year ago, we were talking about there is no alternative, growth at any price. It's all about revenue growth because these companies are being valued on revenue multiples, and we'll figure out profit later. And now we're looking at a 2-year treasury that's trading at 2.6%, right? So that's competition for risk assets for sure. I would say, in our strategy, we've been focused on free cash flow from the beginning. And we've also been focused on strategic positions. So we want to own disruptive and innovative companies that have significant moats around them, right? And there are plenty of those that are out there, and I think the valuations are starting to look more attractive.
Is that a straight line then back to mega cap tech?
No, not necessarily. I would say in our disruptors ETF, one company that I think is particularly interesting is Uber, which has obviously been thrown out with the bathwater. If you think about the kind of free cash flow this company is going to be able to generate in 2024, we're talking about $4 billion in free cash flow against a $50 billion market cap today. So that's an 8% free cash flow yield. Meanwhile, investors are scrambling to buy Procter and Gamble, which, not to pick on them, but we're seeing a lot of heavy buying in consumer staples, where we're talking about a 4% free cash flow yield on 2024. And that's competing against a 10-year treasury at 3%, right? So at some point, valuation is going to matter again. And within some of these disruptive companies, there actually is pretty interesting valuation support.
Uber is interesting for sure in light of the reported employee memo from Dara and talking about the seismic shift in investor sentiment. I mean, not to pick on Uber, but if that is true and investors are going to demand more robust business models, don't we have to break the dependence on certain metrics like adjusted EPS or adjusted EBITDA?
Oh, 100%. And as I said, in our disruptor strategy, we've been focused on free cash flow from the beginning. And also, I think, look, there was somewhat of a bubble in these speculative innovation funds where, investors just wanted exposure to blockchain and crypto and 3D printing. And it wasn't about, are these companies good fundamental businesses? And at the end of the day, Uber is a dominant franchise, and it is an excellent business. The reality is that the business has tripled in terms of revenue over the last few years as it's recovered from COVID. So I get the frustration that there's not a lot of free cash flow immediately, but this will be a positive free cash flow year. And free cash flow is going to ramp very quickly. And I think Dara really wants to upside surprise Wall Street to get momentum back. And so I think the valuation is actually pretty compelling. And frankly, there are other companies that have been thrown out with the bathwater in this, disruptive innovation space. I would point out Etsy. I mean, Etsy obviously is seeing some give back in terms of the tremendous revenue growth that they saw during the pandemic. After you triple your business, it's not surprising to see revenue down, mid to high single digits. You're kind of absorbing the change in consumer behavior. But if I look out to 2024, this is also a company that looks like it's trading at a high single-digit free cash flow yield. And then I would also add just one more point. If we do go into this stagflationary environment, there is going to be a refocus on real growth, like companies that can really grow. And so I think investors should keep some exposure to disruptive innovation.